The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we closed out the trade action on Wednesday and we continue to digest Tuesday's August WASDE numbers, we found green on the screen in the grains and oilseeds, with soybeans the upside leader, corn and wheat relatively quiet on the session, mixed action in the livestock sector. Let's talk about things and get reaction and analysis from Mike Zuzolo with Global Commodity Analytics. And Mike, great to have you join us here again this week. And we've had a little over 24 hours to digest the USDA numbers. And just for starters, your reaction to a 188 yield, a slight uptick in beans, the big changes to acreage, your reaction now that you've had a little bit of time to look at the numbers and digest things, Mike.
Yeah, I mean, I think the best way to describe it, Jesse, is, for me, you can't fight City Hall. That's an old saying. You can't fight City Hall. You and I have been doing this long enough to know that you just can't go against the USDA numbers when it comes to risk management. But you can work around them and you can disagree with them because of the statistics and because of their own probabilities and some of the boundaries that they themselves set up in the end of their reports. And I think I could tolerate the almost 189 bushel yield because, number one, the satellite imagery that they use is a specific type that is much better looking this year than last year. And number two, and this is the most important part of it, I think, is that they stopped on July 27th looking at the VIIRS satellite imagery. And I have probably had at least a dozen calls since the beginning of August. And I have literally been talking probably to at least a half a dozen additional people right before the crop report and right after the crop report that are saying, this crop is nothing like it was back in the end of July. How did they get this number? Well, I think that's part of it. So that's the yield number. I can take the yield number. I can take the fact that they jumped yield 4.3 bushels and we're almost at 189 because of how they measure. But what I cannot take statistically, and I think we're going to have to come back around and look at the yield later down the road, but what I can't take statistically but cannot fight at this point is the 2 million acreage increase on harvested acres with all of these record yields you see around the country. And, you know, we talked about this several weeks ago. I was at about a 182.1, 182.2 corn yield number because I was not pushing Illinois into fresh territory of record yields, was not pushing South Dakota into fresh record territory of record yields because they'd already had one last year. And so with such a large acreage base harvested and such a large increase on the yield side of the equation, I think this is one of those markets where taking you to a 16.74 billion bushel production number versus what we had last month, that's a 6.6% increase. And so if you look at the far right column, you're looking at a 6.6 increase in production between the acres and the yield. And that, to me, that 1.04 billion bushel change in 1 month, that's way out of whack. And what I mean by that in terms of specifics is that last year, for the 24-25 marketing year that's about ready to end, last year in November, USDA gave us a carryover level of 2 billion bushels. Well, if you look at the second column in this visual, that 24-25 ending stocks number is now 1.3 billion. Mm-hmm. We lost 35% of our carryover just in about 7 months, 6-7 months. So this is what we're going to have to contend with. Those are my initial thoughts, especially when it comes to the corn.
Well, and let's look at the soy yield map and the production table there. And I think this ties in with your thoughts on the acreage. We gained corn acres. We lost soybean acres, even though the national average yield did go up just over a bushel. But that was offset with the acreage, production changes, and more. So, I mean, obviously, we've seen this reflected in the moves in soybeans the last couple of days here on the board, Mike.
Yeah, and just talking about these tables, you bring up a huge point to me. Okay, so if I'm so full of angst, if you will, about the corn statistics. The beans are almost perfect because you did take acres down. That would make the more concentrated acres better acres theoretically, and you can push that yield up. I would not be surprised if that yield went higher had it in the future, had it not been for what we may be looking at in terms of a very dry August and early September. We're turning off hot and dry. The weather forecasters told us that 2 weeks ago, and then they threw in the towel in the 1st of August and said, well, it looks hot and wet like July again. But the smaller acres, bigger yield makes sense. The other thing that makes sense is like in the corn, they took the old crop carryover down. And what I really liked what they did in the exports, Jesse, it takes the pressure off of the U.S.-China negotiations, in my opinion, because they've gone essentially down. They went down another 40 million bushels after taking exports down, I think 40 or 50 last month. And notice the exports now at 1.705 billion bushels for August, go all the way over to 23-24 of 1.7 billion. That was the number I've been using, and that's why my carryover level has been running in the fours and mid to upper fours until last month when we got the increase in the biodiesel, and the EPA projections were pushed into USDA numbers. So when you look at these two tables, and that's why I did it this way, and you look at the yields by state, this bean number looks a lot better to me statistically as an analyst than the corn number does. And so I think that gives the beans, along with the weather and along with the tariff truce with China, the mantle of leader to the upside for the short term, meaning probably between now and the next WASDE report, depending on how long that weather market lasts here, how long we can stay hot and dry. Right now, both models are suggesting all the way through the 27th of August, pretty hot and pretty dry.
Let's talk about the soy corn ratio now, the no soy Dees corn ratio. And, you mentioned beans a couple of days in a row here now of good upside moves. You got Nove beans back above 1040 with Dees corn just below 4 now here after Wednesday's close of trade. And a couple things stand out to me here, obviously seeing this spread widen a little bit in the last couple of days, but also too, do you think we maybe priced in that big acre number on the corn side? Is that maybe some reason why this market hasn't fallen further, Mike?
I'm so glad you brought that up, because the listener and the viewer should know we really don't talk about what we're going to talk about before we go on air. But we had talked about the idea that the price of September corn going down to 370, 375 area before the report, in my price model, was suggesting they were banking on in the trade a 2.2 to 2.3 billion bushel carryover. And I'm waiting to see if that elasticity model projection holds this week. With or without the soybeans, it really doesn't matter. But I do think that you bring up a good point. Even without the soybeans, the reaction by the trade yesterday and then again on Wednesday would suggest that maybe, just maybe, we have priced in such a large yield. And I do think that there is a growing number of analysts that are coming out there doing their own crop tours, talking to their own producer clients, saying it's not what it was back in the late July timeframe. And so this spread, this ratio being at a new contract high at 2.635, that's your orange line at the bottom. That means beans, November beans, 2.635 times December corn. You're stretching yourself now. 2.7 to 2.75 is really the upper parameter for this spread historically, Jesse. And so what it says to me is, number one, obviously beans are the leader, like we talked about. Fundamentally, prices are adjusting that way. Number two, if beans keep going higher, say they want to go up to their earlier year high of around 1075, the bigger the spread gets and this ratio gets, the more sensitive corn should become, because as you get to 2.75, the more the beans go up, the corn wants to follow the more, the same amount, I should say, traditionally. And so this brings back the idea of what we talked about again last week. Are we nearing a commodity demand low because of what these reports said and how the market's reacting? And what I mean by that essentially is soybeans last year on the week of August 12th put in their major low at 936 and a quarter. Wheat and corn followed 2 weeks later, corn coming in at 360 and a half, wheat coming in at 493 and a half. We got within, I think, In the wheat, we got within about 5-7 cents of that before the report came out. So this also adds the idea with a lower wheat carryover and stocks to use ratios tightening, the wheat market should be able to support this upside potential if we get it a lot better than it has.
We're talking with Mike Zuzolo from Global Commodity Analytics here today on Market Talk. Mike, let's take a look at some of the world cash values for corn, soybeans, and wheat. And I'm glad you're bringing these up and talking about these today. I saw a little chatter amongst some traders Wednesday morning, and some folks were scratching their heads, they said, until they almost were making their scalp bleed because they couldn't believe that South American cash values and basis hadn't started to weaken more. And so what are you seeing, thinking about things like that and just looking around the world? Let's start with the corn chart. What stands out to you the most outside of the fact that U.S. Gulf corn is the cheapest in the world?
Yeah, and it's the cheapest by about 15% compared to Brazil, or I should say Romania and France. And so when you take, 183.50 into the Brazilian price of 207, we're still about 12% cheaper than Brazil, and we're upwards of 25% cheaper than Romania and France. And this is where this commodity demand low kind of genesis was born from about 3 weeks ago, Jesse, is we're selling a lot. I mean, South Korea came in again for corn on Wednesday, supposedly bought some U.S. wheat as well. And so it does, even with the tariffs, it does feel a lot different than last year when it comes to the demand side. And I'm not saying we're out of the crosshairs yet when it comes to the tariffs. I think the U.S.-Russia meeting is the next big issue coming up here at the end of the week, because to answer your question specifically, the demand is improved, but it's also been the U.S. demand has improved. And why is that? It's because the dollar is down 10% year to date. And so our prices essentially have factored in the tariffs at this point. If we're 25% cheaper than Romania and France right now, who cares about the tariff if it's 25%? So that's what's happening behind the scenes here. And that's why I really want to give this market a chance. And I think most importantly, this is why, and I told this to clients and reminded them last night about this, because of I have been hedging beans more aggressively, next to no corn sales for 25 right now, and still have some 24 corn left. Why would I be in that position? Because of the world supply demand. The world supply demand is still that's exact opposite of the U.S. supply demand, and yet the trade has traded the U.S. numbers. So I've got to be watching here to see if that doesn't change here in the near term.
How about on the soy side? Let's look at the cash prices there. And I know you mentioned China earlier when it came to soy, and that's been a lot of the chatter in the trade this week as well. You had President Trump's Truth Social post calling on China to quadruple their bean purchases. People saying, well, 4 times 0 is 0, and they're going to South America and things of that nature. So how about on the soy side of this equation? What stands out to you on a cash perspective?
Yeah, this is where the corn and beans specifically are garnering a lot more support from the currencies. The Brazilian real against the US dollar is the highest it's been since July of last year. I mean, we're literally at a 13-month high in our biggest competitor's currency right now. And that's why the Brazilian corn price is and bean price here is at 12.18 versus our Gulf price at 11.32 and our Portland price at 10.88. I would double check that Portland price to see if it wasn't maybe a little closer to the NOLA price in red. But be that as it may, you can see the impacts of the strong demand from Brazil to China. And yes, we're not getting Chinese beans, but we're getting a lot of other beans from other countries and soy meal as well. And so again, it goes back to that same idea that maybe, just maybe, this is kind of like 2004, 2005 time period where we've been low enough, long enough. And guess what? There might be tight enough supplies in other parts of the world that we're garnering more agriculture demand in the export market than what we would have thought given these tariffs. And again, I'm not ready to just jump out there and say that. I still feel like there's some crosshairs in the marketplace right now, but I think we're getting closer and closer. And I think this negative report, if we look back on it and say we made a low on that huge yield for corn, I think it's going to be because of the demand side.
How about the wheat prices? Let's talk about those before we go to livestock. I felt like wheat's been kind of trading with corn since the report. That one caveat I'd throw out there to you. What are you seeing on the wheat side, Mike?
Yeah, very much so. And this is where it goes back to the world wheat supply demand numbers got better. The U.S. supply demand numbers got better. And yet before the report, we went to a 5-year low in the soft red wheat. And we don't see the Russian price or the Ukrainian price going back down. Now, wheat is, I think, the key to the end of the week market price action. And the reason I say that is because we know that the U.S.-Russia meeting is going to be probably the most important meeting to whether the war ends in Ukraine or not, and whether we get sanctions put on Russia from the United States. We know they're going to be oil sanctions and oil-related sanctions, but will they also be banking financial sanctions that would limit Russia from being able to sell wheat into the open market? So we really need to watch whether the dollar becomes a big safe haven because it's bad news, or whether the crude oil and the wheat start to move higher to sharply higher because it's bad news. And that's going to be a big, big thing. It's very hard to call right now. But in that sense, while soybeans are the leader to the upside in the short term, especially with the weather, the wheat still matters a lot in the big picture.
Let's talk livestock. I think sometimes folks forget that the WASDE does have meat numbers in there. What are some things that stood out to you when you took a look at that aspect of the WASDE report Tuesday?
Yeah, I couldn't agree with you more, Jesse. In fact, the livestock report on WASDE was just as important as the grains, because USDA's had this mindset that we're going to have about 3% less commercial beef production than what we were last year. But the numbers, the real numbers year to date, were down 3.6%. We've been talking, you and I have been talking a lot about where are those cattle on feed that the USDA is talking about. How can we get to those kind of numbers where we're only down 1.5%, maybe 2% from last year with what's happening in the screwworm category? And so they finally fessed up, in my opinion, and you can see it in the numbers in yellow. July for quarter three for beef production here commercially, July they were at 6.59 billion pounds. They took that down to 6.415. We're right on the, right in the middle of Q3 right now. They did the same thing in Q4 for 2025. Instead of being at 6.6 billion like they were last month, they came in at 6.515. This suggests we're going to be tighter. This report, in my opinion, especially when you look at the red circle down at the very bottom, taking from one month to the next, talk about statistical probabilities, taking a July projected steer price from 229 to 244 in 1 month. That says to me we've got a tighter supply out there than they were thinking, and therefore we fed the bull in this report. So now we put this report up against the screwworm issue. We put it up against the Brazilian imports. We've got 3 legs of a stool that suggest this market can keep on going higher. Big caveat, though, is we've got an update from the Secretary of Ag expected on screwworm by the end of this week. So this is where the monthly live cattle chart, the monthly feeder charts, they're in a breakout type look right now. We need to get back up above that 239.47 record high in the fat cattle. That's the monthly high that this chart shows. I'd love to see a close above 240 as we get towards the end of this month. But the screwworm Brazilian beef issues are going to have to be monitored.
And I do want to ask you too about feed needs here as we think about corn, and we talked about that so much at the beginning of the show today. But thinking about, should we be locking in any feed needs here for corn? I mean, your thoughts on this as we just think about this big picture, Mike?
Yeah, I think in lead month September corn, what I'm going to be recommending to clients is doing half if we close back above 385 in September corn on such a negative report. I think that'd be very powerful. So if we close back above 385, I'll recommend locking in half of the corn feed needs for the next 6 months. And then if we can go ahead and go lower I'd recommend going after 100%, close to last year's lows of around 360. That's kind of the way I'm looking at it right now, Jesse. But this chart really shows you what I was talking about earlier. This is the stocks to use ratios. By pumping up the demand in corn domestically, 545 million bushels in yesterday's report, USDA, and cutting some of the old crop Ukrainian corn, we went from 21.3% stocks to use to just about 22%. That's still the lowest since 2013, 2012. So we're still carrying a 12, 13-year low when it comes to the world stocks after you factor in demand. Trade's not looking at this chart right now.
Mike, any other final thoughts or anything you would reiterate for folks on the show today?
The only other thing I'd throw out, including with that last thing we looked at, Jesse, on that corn, is the feeder corn ratio. We've gotten it back up to around 92, I think, 92 times the corn price is what feeders is trading right now as August gets ready to go off the board. We'll want to be watching for around 100 times the feeder price to the corn, and that tends to be pretty strong resistance.
Mike, how can we get in touch with you if folks want to have a conversation, take a look at your analysis and much more?
Well, I think psychologically and from subconsciously and how you're dealing with these markets and these prices, please reach out for a 2-week free trial. Call me after the market closes. Both of those things you can do on the website, globalcomresearch.com, globalcom with 2 M's, research.com. I really am excited about these markets. I think the supplies of the corn especially are going to come down, Jesse. We've got test weights, we've got kernel depth issues, we've got tar spot issues, and I think we're going to see some lower yields coming. And we need to watch those futures and that basis very closely. And I think we can do that fairly effectively.
Always an excellent conversation. We appreciate it. Mike Zuzolo, Global Commodity Analytics. Have a great week, sir. We'll talk to you next week.
Thanks, Jesse. You too.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.